let's dive in. Welcome, everybody. Welcome to class number 3, the dealing ranges. So, in today's class, I'll be covering dealing ranges and I'll show an advanced use of dealing ranges through the end of the class with exercises also. So, I know most of you are familiar with dealing ranges, but dealing ranges also can be really it can get really overcomplicated as well and overlooked. So hopefully with this class, I'll be clarifying the ranges and getting rid of all the questions, all the question marks you might have at the moment. So what is a dealing range? A dealing range is a tool which we use in trading to determine mainly pullbacks between 2 points. These 2 points being sell side and buy side, right? Everything is around liquidity, or vice versa. It basically helps us to determine either entry points in the short term and or it tells us the narrative. Without narrative, we don't want to be in a trade without knowing the narrative, right? Because you might have a bias, but when it comes to narrative, meaning how it trades into that bias, without knowing that information, you might get chopped, you might get stopped, you might have a bad entry or whatsoever. And dealing ranges are a great tool to understand the narrative. Now, different dealing ranges can be present simultaneously at around the same levels, which is the most confusing part of dealing ranges because there'll be different time frame dealing ranges and stuff like that. Because of that, it is really important to have a multi-time frame analysis and understanding of multi-time frame analysis as well, like top-down analysis, right? So, speaking of which, dealing ranges can be divided into three subcategories, which is lower time frame dealing ranges, intermediate time frame dealing ranges, and long-term or higher time frame dealing ranges. I'll dive into them separately in detail. But for now, let's just give it three subcategories, right? And these ranges usually refer to time frame. It's relative time frames. So a dealing range in the marketplace provides us a framework to trade within, right? Without a framework, there's no reason for us to pull the trigger, push the button, right? The market moves from premium to discount or discount to premium to run on liquidity, which is the typical price action in the market. That's why it's going up and down before knocking out any liquidity pool. Dealing ranges also can help us to understand if the market is in a pullback or is in a reversal, so we can size accordingly, or we can just trade within the order flow itself. The dealing range could also be adjusted as the market moves. As you see, liquidity pools are getting knocked out, you must be adjusting your dealing range. The dealing range helps us for position management as well, which is very important in my opinion. Especially if you want to go into a day trading instead of scalping the market, it becomes really handy for position management purposes because then you can be trading the whole trending days from 9:30 to 4 p.m. by using this concept. Applying dealer ranges. By the way, I don't know if you can hear the noise back in the background, but there's something going on. I hope it's not like too loud or whatever for you guys. Anyways, so applying dealing ranges. How do we use dealing ranges in the marketplace? When it comes to application of dealing ranges, two things really can play an important role, right? First one is order blocks. Second one is liquidity, and the reason being is our main concern is the most recent swing leg or expansion leg. And expansion legs always starts with order blocks, right? That gives us the dealing range low or high. And second one is liquidity, basically because it forms the dealing range high or dealing range low, depending on the order flow of the market. The trader's main concern should be identifying the most energetic moves and adjust dealing range as the market moves. Like I previously mentioned earlier, as liquidity gets purged, you need to be aware of that, and you need to adjust the dealing range accordingly. Otherwise, you're not going to have the correct framework. Using dealing ranges, first we need to identify the most recent swing legs range premium, discount, and equilibrium, which is I call range EQ, 50% of the Fibonacci. So it's the mid-level of an expansion leg, essentially. This is a confusing part also because mostly we do not consider time decay in the marketplace when we look at the price, and because we don't consider time decay, we might be looking at a wrong framework. Now remember the first thing I said on this page, order blocks. That is the key word. A dealing range low or high will always be in the form of an order block. That is an important part. Now, once we establish the dealing range, now we have the framework for our trades. And this should be at this point you should already know the drawn liquidity, right? So the first things first, you got to know the drawn liquidity. That's your first task. Once you have that down, now you need to have a framework. That's where dealing ranges comes handy. That's the second thing you should be doing before pushing the buttons. In buy models, price will always move from premium to discount or range equilibrium, which forms the pullback. And in sell models, price will always move from discount to premium or range equilibrium, which forms the pullbacks on the sell model. The goal here is to identify where the pullback is to improve the executions, right? Because this happens quite a lot also. Like you might know the drawn liquidity, you might have a fair value gap execution, you might think that that's an A plus setup in that, whatever the case is, but you might get stopped out before the price makes the run, right? That is usually because you don't have the framework, meaning you're probably longing in a premium array, or in the sell models you're probably shorting in discount arrays, which is why usually you get stopped out. And the goal here with the dealing ranges is basically improving your executions. That is the key word here, improving the executions, meaning when it comes to trading, guys, what's more important is it's not like having losses, or let me put it this way, it's not like being wrong or being right when it comes to trading, especially day trading. What matters the most is being less wrong, right? And to be able to be less wrong, you need to have better executions, right? And that's where dealing ranges comes really important role. As an example, let's take a look at this example. For this example, I already established a dealing range. So the first thing I'm doing is basically looking at the order block, which is this 2 consecutive candles. This sets the stage, or this creates the expansion leg, right? Expansion leg, what I mean by that is the most energetic move. So once that order block is violated here with this up close candle, that is an energetic move. Now that confirms the order block, right? Now you can expect an expansion or distribution higher. Once you have the swing high, that forms the expansion leg high. So from the order block low, here the sell side, there's a lower wick there, so I'm taking it from there, swing low, to swing high. That gives us the framework. That gives us the dealing range. Now within that dealing range, there are 2 important things. First thing, the upper portion of the dealing range is what we call a premium area, right? And the lower portion of the dealing range is called discount area, discount zone. Now, one important thing here is adjusting the dealing range as market goes, right? Before market starts turning back, like this with this candle here, it keeps pressing higher and higher and higher. So it takes out the buy side. So initially, the dealing range was supposed to be from this swing high to this swing low, or the block low, right? was as market moved higher first before pulling back, now you have a new dealing range. The swing high here is a new dealing range, so a new framework. Now before the pullback, it ran the highs one more time. Now you got to adjust the dealing range one more time, and you got to anchor it at the last swing high. Now, knowing this information, once you have the dealing range, swing high, now you have the framework. What you could do with this framework is you can anticipate pullbacks into range equilibrium, which is the mid-level of the range, or within a discount, right? So anytime you see a fair value gap or a premium array, discount array, whatever the case is, you have to neglect, like in this case, you have to neglect the premium arrays. For example, the down close candles here, the fair value gaps there, here, and the upper portion of this big fair value gap has to be disregarded, just because if you want to be in a long position, you shouldn't be entering a long buy position in a premium area. But instead, what you can do is look at range EQ or anything below and see or spot any PD arrays below that. That should be your point of interest for long entries. And then you can target whatever the case is over there. That's how dealing ranges become really important role when it comes to executions. And over time, with more experience or with seeing dealing ranges and annotating dealing ranges more and more, your eyes will be trained to disregard all the wrong PD arrays. I usually call them invalid areas. Let's go on the second slide here. This is a buy model example, just like the previous example. So we have an order block at the low here. Once price expands, once candle starts printing, confirming the order block, now you can expect an expansion leg, right? Once the swing high is confirmed here, because now, first of all, you have a swing high here, gets violated, there's a new swing high, gets violated, there's a new one, gets violated, and that after this one, it just breaks lower, breaks down, right? Once it breaks down and confirms the swing high, now you have a framework, you have the dealing range from order block low to expansion leg high, swing high. Once you have the framework, now you can work within that framework. Now what you need to be concerned here is if you're long, you need to be looking at the discount PD arrays. In this case, there is a fair value gap here in the discount, as I annotated discount fair value gap, and a lower fair value gap, which is also in the discount, a discount fair value gap. So now if you want to be in a long position, you should be longing this market in or below range EQ in the discount areas. Now in the discount areas, you might have a fair value gap, you might have an order block, you might have a breaker. You don't have to have all of them simultaneously. That's why having an advanced understanding of PD arrays is really crucial, because you got to be looking at all of those things. And as you can see, it just pulls back into a discount fair value gap, then starts rallying one time and one more time here with the energy. Shift the structure, shift the sentiment. Now the sentiment and the order flow have changed here. Now you can enter longs and target whatever drawn liquidity is. For the sell model example, same thing. We have three up close candles here, and then price breaks down. Once it breaks down, it confirms the order block here, the last up close candle or the consecutive candles, depends on the conditions and the consequences. The order block high becomes the range high, expansion range high. Now you can expect an expansion, breaks lower. Once it breaks lower and confirms the swing low, now you have a dealing range in the sell model. The dealing range is now established from order block high to expansion leg low, swing low. And once you have the framework, now you can expect price return back to range equilibrium or its premium for you to get short sell positions. Once it does that, now you can actively look for executions. But before that, you shouldn't be looking at any PD arrays present in the discount area. Now, this is an important thing, pullbacks, because they're usually overlooked by traders, and it is really hard to understand whether we are in a pullback or not, usually. Especially deep pullbacks. Deep pullbacks, what I mean by that is basically, let me go back to this example again. Deep pullbacks, what I mean by that is basically it's not trading back into range equilibrium only, but it's going further more, almost like testing the order block, like retracing deeper and deeper as if it's going to take the high. But that's usually not the case. It's just deep pullback. But when it comes to deep pullbacks, you should always have a lower time frame confirmation. And what I mean by that, I'll show you in an example, and I'll explain it there in the next couple slides. I'll go over deep pullbacks here a little more. So deep pullbacks, like I just said, is retracements to back to the most recent expansion legs extreme. Now, order blocks are usually at the lows or at the highs. What I mean by extreme is those levels. For example, in a buy model, when price is of close proximity to its order block low, that is a deep pullback. You consider that as a deep pullback. But in sell models, when price is close proximity to the order block high, that is a deep pullback. You can consider that as a deep pullback. Now, deeper pullbacks are caused by usually short-term SMT divergences most of the time. And these SMT divergences usually fakes out the traders as well as ICT traders most of the time because when in deep pullback legs, what you're going to usually see is right here, it usually violates the PD areas along the way to complete the deep pullback and or creates new PD areas on the way. So when you see a deep pullback into range EQ, it might create a new fair value gap, for example, or it might just violate an old fair value gap in the bullish order flow. And we as ICT traders usually think like, oh, market structure shift happened. Now the order flow has changed. I need to execute in this fair value gap on the pullback. However, the case is there's actually a deep pullback and it starts reversing right away once they enter that fair value gap. And I'll show you an example for that as well. Because of that, understanding of deep pullbacks are highly important in my opinion. And also, the way to understand deep pullbacks, whether it is a pullback or not, it comes with drawn liquidity. So understanding of drawn liquidity. If you don't have drawn liquidity, that's the first thing, right? Like first things first. If you don't know drawn liquidity, just don't look at the charts, basically. That's the first task. Because without knowing whether price wants to go lower or higher, you don't know if it's distributing or expanding or pulling back. Liquidity is your map. Remember, in the first class I said, think liquidity as if it's your map in an unknown country, right? Now, here's my tips for deep pullbacks. Just because this happens quite a lot, especially if you're operating on the 1 minute, you'll see it a lot. So if you ever find yourself getting stopped in a position having the correct drawn liquidity, deep pullbacks are usually the main reason for this problem. If you don't know what's going on, you might reverse your position and get stopped one more time. And we don't want that, obviously. And tip number 2, do not consider market shifts unless it's occurring at the most recent expansion legs order block. That is important. I'm going to read that again. Do not consider market shifts unless it's occurring at the most recent expansion legs order block. Otherwise, you are trading the pullback or the deep pullback thinking it is an expansion. But in reality, it is just a deep pullback faking out traders. You'll see examples here. So deep pullback, identifying deep pullbacks. So in this example, this leg is the expansion leg. Why? Because there's an order block here. Down close candle, and right next to it, up close candle violates it, and it keeps pressing higher and higher and higher, which confirms the order block. So the order block low is the expansion leg low. Then once the market confirms the swing high here, that is expansion leg high. Now you can draw your dealing range from order block low to swing high and consider that as your framework. Once you have that framework down, you should not be, if you're long, you shouldn't be considering any PD arrays in the premium area. So the upper portion of this dealing range should not be considered for long positions. If you do, that is at your own risk. The odds are against you. Now, if you look at the discount area, so the lower portion of the dealing range, you'll see a fair value gap there. That is a valid point of interest. And the order block also is a valid point of interest. Now, looking at the price furthermore, what you'll see here, as I marked that SMT divergence between assets, here at the highs, bearish SMT divergence causes a deeper pullback. So what happens is, in the first pullback leg here, market trades into range equilibrium, then rallies, right? And that rally causes an SMT divergence. So this asset fails to run the highs, whereas the other asset runs the highs, so making the higher high, causing bearish SMT divergence. Once you have this SMT divergence in a bullish order flow, you can anticipate a deeper pullback or a deep pullback, right? This SMT will cause that pullback, and it starts rallying lower. And one important thing here on this deep pullback, so there is a bullish fair value gap. It gets violated with one candle, and on the way down, it prints one more fair value gap, bearish fair value gap, and another one right here. They are not valid fair value gaps. Why? Because in this example, say we have a bullish drawn liquidity at the highs, right? We are bullish, order flow is bullish, drawn liquidity is bullish. We established that. Now you know that this is the deep pullback, and you shouldn't be considering the fair value gap on the pullback leg as your point of interest to go short. That means you're going against the order flow. And as you can see, it is really important to understand the drawn liquidity, otherwise you don't know what you're doing. And moving forward with the price here, test the discount fair value gap, kind of chopped here, a little bit accumulation. And this is your lower time frame confirmation. Once the price, after touching the discount fair value gap, shifts the most recent swing high here, this is the swing high, trades above it, candle close. Now that means pullback is over, or deep pullback is over. Now you can safely enter long positions after that happens. But before that, you shouldn't be considering any positions, because that the confirmation is not there. If you want to be safe, if you want to have high probability trades, you have to wait for that shift in the structure. Now that confirms the change in the order flow. You want to be in the order flow of every time frame, whether you're trading 1 minute or not, doesn't matter. If you're trying to long a 1 minute bearish order flow, you're probably gonna get stopped. Lower time frame confirmations. As I just hold on a second. What's going on here? Same example. Okay, I'm gonna skip this, I guess. Okay. Cool. This is another example from the same figure I showed earlier. So say this is your higher time frame premium discount dealing range, right? As price trades down into the discount area, you can go down on the lower time frame. For example, let's say this is the hourly chart. Once it trades down there, you can go on the 15-minute to just narrow things down. So your interest is this area. You can look for a lower time frame PD arrays there. So on the next slide here, you'll see the 15-minute look of the same price action. Dealing range. This is the discount portion of the dealing range, right? And on this time frame, you have another fair value gap there. So you're narrowing down your point of interests, right? Price trades down into there, reacts strongly, right? Once it comes down there, your point of interest, now you can go on even further, even lower time frames. For example, a 1 minute time frame. Let's take a look at that. Here's the 1 minute time frame. So it trades down there, right? Shift the structure first, comes back down, drops a bit, comes back down one more time. Here, it starts rallying with energy one more time here. Shift the structure, that's your lower time frame confirmation, right? And then the order flow changes. So now it starts being in a buy model. And you'll see the new expansion leg here is being delivered one-sidedly. Now you can start tape reading after that market structure or start executing. Structure shift with energy creates a fair value gap. That is the first execution level. Going higher, comes back down, tests the order block, rallies, and all these fair value gaps are confirming the order block and rallies to the drawn liquidity. Now, if you do not have this structural shift on the lower time frame, so if you don't have lower time frame confirmation, it's likely that you'll get stopped out because it might just sweep the lows one more time, or maybe go into an even deeper pullback, right? Because essentially this is a deep pullback. It's going all the way down to discount levels. Without having that structural shift on the lower time frame, it's not a high probability setup for you. You gotta wait for that order flow to change on every time frame. And that's very important. Like I used to catch those knives as well, having point of interest like this, and I used to get like stopped a lot because of that. I got punished for that. Now you got this where it comes. This is where it comes patience. It pays off. You know what I mean? Like you gotta wait for that and be patient. If it doesn't give you the structural shift, or let's say if it gives the structural shift, but no PDR is there, that's fine. Just let it go. You know what I mean? If it doesn't expand higher, like with energy after the shift, that means you don't want to be in that price move anyways, because it's not as strong as you want to be. You know. Now, long-term dealing ranges. This is the confusing stuff, as far as I've seen so far. So long-term dealing ranges is basically the higher time frame dealing ranges, okay? Which can be monthly time frame or weekly time frame, daily time frame, all the way down to 4 hourly. I would consider 4 hourly time frame as long-term as well, just because we're mainly day trading or scalping. And we use the long-term dealing ranges for determining the directional bias, right? If you look at this example here, order block there, price expands, there's a swing high there, right? Once it confirms that level as a swing high, now you have the framework, and this is AMD weekly chart, by the way. Now you have the framework. Once you have the framework, you can expect the pullback into a discount array, right? And that's what it does here. It pulls back into discount array. Once it's there, you know the order flow is bullish, right? When the pullback is over, it's going to rally and takes out the buy side. And that's how you get your directional bias using dealing ranges. And the narrative as well. Like you anticipate that pullback. And anything above the range EQ, if you're bullish, is an invalid PD array. So that fair value gap above that range EQ here is not a valid PD array. You should be disregarding that level. So just like I mentioned, we use the long-term dealing ranges to anticipate market pullbacks and determining directional bias. So unless price trades below the order block low, the order flow is still bullish. That is your directional bias. You're expecting higher moves, higher prices. That's how you establish the directional bias. But if it was to just like rip through the discount fair value gap and violate the order block low, now that means the order flow has changed. Now you can look for shorts, and your bias has changed. Intermediate time frame ranges. So intermediate time frame ranges usually refers to hourly or 15-minute time frames. Sometimes I would consider 5 minute as well. Not rarely though. Usually hourly and 15-minute time frame ranges. And we use the intermediate dealing ranges for the intraday narrative, right? Narrative is very, very important. Otherwise, if you don't understand the narrative, you'll be probably like executing quite a lot over trading or getting stopped with your positions, knowing the drawn liquidity. And that's really painful, you know. Having the drawn liquidity but getting stopped in the same direction is very painful. So we can use the intermediate term dealing ranges to anticipate where manipulations could take place. Meaning the pullbacks or deep pullbacks, right? In this case, if you look at this example here, let me just go over that real quick. This is Nasdaq 15-minute chart. There is a swing high here, then a swing low here. In between, that is an expansion leg. So the up close candle right before the expansion leg is your order block. So above the order block, there's a swing high. That's the most recent expansion legs high. So expansion leg high. This is sell side once the swing low is confirmed. Most recent expansion leg low. So from that high to low is your intermediate term dealing range. And in that dealing range, there's a fair value gap in the discount area, and another one in the upper portion, meaning premium area, right? Now, what you can do or how you can use this information is basically if you're bearish, let's say in this case, I annotated drawn liquidity as this low, right? That might be a higher time frame point of interest or whatever the case is. Let's say I established that drawn liquidity first, then got this framework. Now, once I look at this intermediate time frame, what I could say is if price wants to go and draw liquidity, it has to come back up into the most recent expansion legs premium array to go down. So what I'm basically doing here is if price is drawn into the sell side here, how is it going to be delivering there? And that gives the narrative. So by doing so, I'm disregarding all the PD arrays below that range low, so below the lower portion of that range, and I'm waiting for price to come back up, and that's how I can be on side with the market in terms of narrative and bias. It also trades into an order block here as well, same level, and then rejects and keeps selling off into drawn liquidity. That's how we use intermediate term ranges. How I would read this is basically like I would shift or I would switch through in between time frames, let's say hourly and 15-minute, whichever has the most energetic move, and with PD arrays, I would use that time frame. Because at the end of the day, it is fractal, right? So whatever you see on the 15-minute applies to 1 hour. In this case, I preferred 15-minute because it was cleaner for me or clearer for me. So we can use intermediate term dealing ranges to anticipate. Also manipulations. Anticipate where manipulations could take place into, right? This information also can be used where the Judas swings at New York Open could be. So in this case, this could be the Judas swing at New York Open, right? You can use that information. You can have that information down with intermediate term dealing ranges as well, right? Just by looking at the intermediate time frame right before New York Open. We can also use them to anticipate intraday pullbacks. The same thing, pullbacks and manipulation in the opposite direction of the actual drawn liquidity. And intermediate term ranges can also be used for position management. This is how I would use for position management. So once I see it trading lower, right, I would use every candle or every PDI on this time frame for my new stop loss. So let's say I entered here, there was a lower time frame confirmation, I entered somewhere there, then it started breaking down, right? Once it takes out the low, I use these candles open prices for my new stop loss. Like for example, this expansion distribution, its open price will become my new stop loss. And then once it breaks lower one more time, now my new stop loss would be the open price of that expansion leg or its high, whichever you prefer. I usually prefer open price, but you gotta wait for the expansions first. because now you'll have new dealing ranges, right? For example, here, if you take a look at the second leg, order block high, expansion leg low, because it expands here and with energy. Now you have a new intermediate term dealing range. Unless order flow changes, that should hold the price into drawn liquidity. I hope that makes sense because position management is highly important, especially if you want to become a day trader. Not so much for scalp, but if you want to like build yourself into holding positions from like 9:30, 10 a.m. to 4 p.m., this comes really handy. And in the first place, you'll be emotional, which is pretty normal, but after some time, you'll get used to that holding positions like that. Obviously, you're not gonna full pooling, but like um, after taking partials, you can just leave a runner or something. Now, short-term dealing ranges. This is the last subcategory for dealing ranges. Short-term dealing ranges, which is basically the lower time frame dealing ranges, 5 minute, 1 minute, or lower, if you're using 30-second or 15-second charts. For the usage of the short-term dealing ranges primarily is for entries. So what I do is I look at the most recent expansion leg, right? Same deal. Order block here confirms the order block. Now order block low, I consider that as the expansion leg low. Once market confirms the expansion high, the swing high, now I have a framework, right? Now on the short lower time frame, what I do is I expect price to come back down into its discount array or range equilibrium for me to consider a long position. Unless it does so, I just stay flat. That's how I use the short-term dealing ranges. For me, when I look at this price action here, what I do is first things first, draw on liquidity, right? Let's say I have that down. That's the first task. Then I wait for market sentiment change. Once it's changed, now I expect or I wait for an expansion leg. Once it's there, now I have a framework. Whenever I have a framework, now I have an entry point of interest, the discount area or the equilibrium. Once it trades into there, now I can go long and target the drawn liquidity. So for me, any PD array above the discount or range, like a proportion of the range, is an invalid PD array. So the proportion of this fair value gap is not a valid PD array for me, and there is a volume imbalance there. It's not a valid PD array for me. And also you can use short-term dealing ranges for position management purposes as well. So as market moves, you adjust your dealing range, right? And you keep your stop loss below a discount PD array. If you want to full pull positions or if you want to hold your positions, runners, whatever the case is. Short-term dealing ranges aim to provide the best and the highest probability entries, just because like this is a great example for that. Like if you were to long the volume imbalance here or the upper portion here, the risk you're taking on would be much bigger. So it is providing the best and the highest probability entries. And as a trader, just like I mentioned earlier, your job is to buy long and discount, or if you want to sell short, you have to be selling short at in premium or range equilibrium. Otherwise, you'll be taking more risk and you might get stopped. You might get stopped knowing the drawn liquidity because you would long here, your stop would be, I don't know, maybe at the low here, you would get stopped. Now you're wicked out, but price moved in your favor afterwards. And it is painful to watch that price action if you get stopped. Now this is a position management example for using dealing ranges. Hold on 1 second. Okay, so this is the NASDAQ 1 minute chart. Right, there's an SMT divergence, bullish SMT divergence. Then market shifts. Where's the shift at? Okay, here. There's a market shift there. And then it rallies, creates an SMT divergence, set the stage for the market buy model. The first fair value gap could be used as a long entry. And in the short term dealing range from the order block, this is your order block. It should not get violated because otherwise the expansion leg has failed, right? You can use your stop loss there. And as market moves higher and higher, now you can adjust your dealing range, meaning from the order block low to its new swing high, right? You use that dealing range, that framework to move your stop loss. And you should be holding or keeping your stop loss below range EQ or below discount arrays. In this case, there's a fair value gap in discount, another fair value gap in discount. You should be putting your stop losses below those levels. But when it comes to position management, you should not be emotional. You shouldn't be thinking like, oh my God, if it turns back on me, I'm leaving this much money on the table. You shouldn't be concerned about that unless you're scalping. So this is the same price on 5 minute. So that's basically what I was explaining here. Say you entered in that fair value gap, right? Let's go on the 5 minute. Your long position is there. Order block, same order block. Now as price expands and confirms the swing high, this is the confirmed swing high, expansion leg high because it starts breaking down. Now you have the framework there, short-term dealing range, right? And once you have the framework, you look at the discount fair value, discount arrays, and the range equilibrium. Now in this case, there is a discount fair value gap, this lower portion of this candle, and there's an order block. Now as price moves higher, now you can put your stop loss right below that discount fair value gap, and you can save your position with that. You should trust that discount PD array. And your entry is here, so your stop loss would be in profit. And here, as you can see how it pulls back. When it pulls back into the discount array, it violates a busy bullish fair value gap, and on the way down, it creates new fair value gaps. And one more thing, I mentioned this earlier. It shifts the structure here, as you can see. With that candle close, it shifts the structure, but this is not an order block. The order block is here, so the real sentiment change would be a violation of this order block. You got to be aware of that. Otherwise, you would be shorting this fair value gap, right? Unless you know the drawn liquidity. For me, how I read this is because I know the drawn liquidity before doing all this work, I would say this is the pullback. The fair value gap should be knocked out right away. And that's what happens. Like it knocks out with one candle. Now it's an inversion fair value gap. Let's go further. So advanced use of dealing ranges, which is implied dealing ranges. Now, before getting into this stuff, let me just give you a side note here. I am actively working on this stuff myself as well, so it's not a completed work as of now. But I'll just share it regardless, so you guys can back test it or forward test it if you want to, because I've seen it working quite good so far. So what is an implied dealing range, first of all? Implied dealing range is basically used for anticipating drawn liquidity at untouched levels, basically all-time highs, right? Just because we are trading into all-time highs right now, that's mainly why I want to share this at the moment. So how we imply a range is we basically anchor the range equilibrium at the smooth edges, okay, and the pullback, so we can anticipate a drawn liquidity, because remember, market will always bounce from a range equilibrium or discount or premium area, whatever the direction is, right? So here, if you look at this price action, there's an order block here. Once the market shifts like that, violates the swing high, now you have a confirmed order block. That's the expansion leg low, right? Then it expands higher, 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 right? Swing high here. That swing high, after that swing high, there is a pullback here. So its market starts breaking down, right? But it never comes down to range equilibrium or a discount. Once it shifts the structure one more time, now the pullback is over, or the flow is bullish again. By using that information, now you can imply a dealing range, because what you can imply, what we imply here is basically the bounce here, the wicks was at range equilibrium. By doing so, or by implying that, we can just extend the range high and by anchoring the range equilibrium at those lows here. So when I say anchoring range equilibrium at smooth edges in the pullback, so in the pullback, smooth edges, I anchor the range equilibrium there, move the dealing range high, right? And I got this level right there. Now I can anticipate drawing liquidity at all-time highs at implied dealing range high, right? And as a confluence, what I like to do is I look at the manipulation legs, standard deviation projections. If it aligns with the implied dealing range high, perfect, I'll use that level. In this case, it was aligning with -3 standard deviation. So I pulled the dealing range high there, and I looked at the range equilibrium. It looked perfect, and that rallied. I'll show this as an example actually before moving forward because it's in the back. Okay, let me read this real quick first. So for further confluence, like I just said, I use standard deviation, standard STD projections of the manipulation leg. So when the pullback and the manipulation is completed, you can now use the new dealing range, the implied dealing range, to see where the new ranges, premium, and discount zones are. I'm going to explain this in an example on the chart in a second. And based on this new data, now you can safely execute positions. Now let me jump on to a chart there. It's the same price action here. You'll see on the on Nasdaq daily. This is hold on. So this was the order block I mentioned here. Once market shifted the high there, now the order flow is bullish, right? Market structure shift. Now you patiently have to wait for a dealing range here, right? You're waiting for a swing high to get confirmed. So you have a swing high there. There's the swing high here. You can pull your dealing range from order block low to swing high, right? Now you have your premium array and the discount array. Anything above or in the upper portion of this range is not a valid point of interest for longs. You should be looking at the lows here, the discount PD arrays, fair value guys, breakers, order blocks, whatever the case is. Let's move forward. Now price violated that high, meaning the pullback is now completed. Market is ready to rally because if you also look at this price action here, now it's all accumulation, right? Manipulation, distribution. Now it's in the distribution phase. Now by anticipating or implying that the price has to bounce from a range equilibrium or a discount in the buy models, I can say that this area should be or should have been the range equilibrium, right? Once it shifts the structure, confirms the pullback is over, I can imply that was the range equilibrium, right? And I'm anchoring the mid level of that range at the body, the smooth edges, right? That's what I'm doing over there. Implied dealing range gives the implied dealing range. Now, as a confluence, I'm looking at the last manipulation legs, standard deviation. And I see -3 standard deviation is clock's proximity, so I'm lowering it down to see how range equilibrium looks like at that level. Seems good for me. It touches one time and rallies immediately. So I'll use that as a point of interest and draw liquidity. And going forward, what I do is now I consider, go further, I consider a new dealing range here. Oh, hold on a second, one sec. Now we have a new manipulation leg here, the pullback leg. Now I'm taking the new range, using that low, order block low, and now my new framework becomes this. right? Now I'm looking at the discount of this range and the premium of this range. So I want to be in a long position within this portion of the range to target the -3 standard deviation projection here, or the implied range dealing range high. Okay, sure, Ivan. Let me finish this real quick, then I'll take your question before I get back to the presentation. Now moving forward, price rallies, comes back to EQ one more time. Discount. So this was the point of interest. This is the pullback, and it starts rallying to -3 standard deviation. So you see how, I hope you see what I'm doing here. So the first thing first, imply dealing range. By implying that dealing range, I'm getting an all-time high drawn liquidity target, right? Then I'm waiting for the market structure shift. Pullback is completed with that shift. Now, once it's completed, now you have an order block there. So your new dealing range or your new framework to target the -3 standard deviation, you're working within that framework now. You see, it's pulling back into a discount raise there and the rallies afterwards. Now you have the new manipulation here. You can move the same, use the same strategy or case moving further as well. This is the pullback manipulation. Now you can look at the standard deviation of this level, right? Imply a dealing range using these levels as your equilibrium of the range, and do the same work moving forward as price goes. Ivan, I can take your question now before I get back to why third and not fourth. Just because, okay, that's a great question. Hold on. That is because I'm gonna add 4 here so you can see better. I'll delete all that. So here what I do is, initially, on this leg, I'll go back a bit more to there. What I'm doing is, just going to delete the standard deviation, okay? So you don't get confused. Dealing range should be from order block low to high, right? To buy side. Now that the market has shifted here, now the sentiment has changed. The market should we should see a continuation higher here. Just the structure shift is there. Now it should press higher. Now, knowing that information, I'm anchoring a new dealing range here at the bodies, right? So I'm pulling the range higher, looking at this range EQ, aligning with the bodies there. Now it's aligned, as you can see, range EQ is there. Now I'm saying the drawn liquidity, anticipated drawn liquidity, is implied dealing range high, which is this level. Now for further confluence, I'm looking at this manipulation like standard deviation projections, right? And that high, hold on, let me add 4 as well. And my implied dealing range high is the closest proximity to -3. That's why I took -3. If it was 4, I would have taken 4, if that makes sense. So I lowered it a little bit to adjust it. Does that make sense? So I'm looking at the closest proximity to the standard deviation projection. If it was 2.5, I would have taken 2.5. Perfect. Ivan, I'm all ears. You want to join? Okay. Hey, how you doing, buddy? Yeah. Mm-hmm, mm-hmm. Here, there. Oh, okay. Here, as the dealing range high. Yeah, I see what you say. So you're basically asking, when you saw this kind of price action, why don't you consider? You do consider it. That's why. That's the thing. So when you're watching price live, this is your framework. But immediately after, it violates it. So now you have a new framework. So you gotta wait for the new swing high, one candle, two candle. It's not confirmed. So now you have to adjust your dealing range that because it is the high that swept the buy side, right? Now you wait for that to confirm. Now it's confirmed. Let's watch it. Now it's violated one more time. As it confirms as a swing high, now you adjust your dealing range one more time. Now you're still waiting. Now in this framework though, let me just say one thing though. In this framework though, unless that high gets like violated one more time, this is your framework. So you expect that price to come down, right? So going further, it comes down a little bit. Immediately after, it shifts the structure right there. Once it shifts it, now the sentiments has changed. Now you can expect. Now that means pullback is over, essentially. Like simply put, yes. So first of all, let me just put it this way. I do not use standard deviations at all. But if I want to like target like him, what I do normally is I look at breakers standard deviations rather than manipulations. But I don't look at specific. So what I do is basically, let me just show it for you. Breaker here, right? So I look at the standard deviations of that breaker. Let me reverse that real quick. And how I read these levels is basically like I'm looking at the liquidity on to the left to see whichever is close proximity. So in this case, I would have taken minus 2.5 because it is the most closest proximity to this high and also volume imbalance right there. So these are the point of interests. So that's how I would read it. I wouldn't generalize these levels as in like minus two is this, minus four is that. You know what I'm saying? That's personally me though, but I'm not a huge standard deviation guy. Just so you know. Thank you. I appreciate your questions, man. Cool. Okay, I'm gonna go back to the presentation. Before going back, if you guys have any questions about this, I can just answer it right now since I'm already here. This is essentially what we are having at the moment on the daily chart on Nasdaq as well, by the way. Waiting a couple minutes here. I think Trader Dio has a question. Just want to say that Dexter's standard deviation framework is really good. I use it. I mean, I'm not familiar with his work, so I can't say anything about it. I really don't know about anything about Dexter's work. So I'm sure it's pretty good though. I don't know. I don't know the guy as well. So rather than Chop, Chop is real. All right, let me get back to the presentation. So here, this is basically what I meant by based on this new data. So the new dealing range, the new implied discount, implied premium, you anticipate pullbacks into those levels, and you can look for long entries over there. This is another example. This is Nasdaq 4-hourly chart. Order block here. So order block low is the dealing range low. Price expanded energetically, expansion leg. high here, right? So we have the framework from low to high. Price comes down, pulls back. So this is all this price action. This is Nasdaq like recent price action also. All this price action is just a pullback, right? Once market shifts the structure, now that means pullback is over. If you look at the lows here, it never touches to discount or range equilibrium. So knowing that information, it always has to bounce from EQ or discount and buy models. You can anchor the implied dealing range using those lows or the bodies there. Here, I'm implying the dealing range, anchoring the range equilibrium to those bodies, right? Now we have a new PD arrays, implied PD arrays, and a new target here, which gets tagged later on. To add confluence, though, you can use the standard deviations. Let me see if I'm showing it here, though. So anchor the bodies here. The most recent manipulation from high to low using those standard deviations minus 2.5 standard deviation is at around the same level with the implied dealing range high. So now you can pull up new implied range from the low to here, so you can work within that time, within that framework right here. This is the new framework. As market prints here, you can enter or look at the discount arrays. In this case, there's a bullish order block in an implied discount array. You can use that to go long, target those implied highs and stuff. And obviously, with the implied dealing ranges, the PD arrays has changed. They change as well. So you gotta adjust those levels too. Here, the same example: order block low, expansion level high. Right. This is the order block, the big red candle here. Order block low, high. This is the dealing range. Price shifts the sentiment here. It shifts the structure. Once the shift is there, now you can say, wait a second, this was supposed to be at range equilibrium or discount. So you can pull your dealing range, anchor it to the bodies there, and imply a drawn liquidity at the height there. And the last pullback leg, you can use its standard deviation levels there. As you can see, it aligns with -2, and you can target that level safely. But before doing that, make sure to look at the new data dealing range from the low here. Consider this as an order block from the low to implied high. Make sure you make yourself aware of the its PD arrays as well, that dealing range, that framework, so you can long it or short it, whatever the case is. It rallies, comes back. This is a deep pullback and rallies afterwards right away. So in this case, a deep pullback was into a discount PD array, a discount fair value gap. This is the framework you should be working on. The last manipulation, implied drawn liquidity. So that's the framework. Comes back down into the implied discount fair value gap. And as long as this order block is holding, there is no sentiment change or structural shift. So let's say if there was a swing low there or somewhere in this price action, you should not be considering that as a shift in market structure, because essentially the anticipation is price going higher. So yes, that wraps up the class. But for an exercise, I believe this is the ranges are very important in my opinion, and because of that, I really would rather have you guys take this exercise rather seriously. And I'm going to post it in the exercise channel so you can refer back to it later on if you want to. So going further this week, what I want you guys to do is read the price action either in hindsight or during live sessions, whichever is more convenient for you. I want you to note the 15-minute and 4-hourly, and if 4-hourly is not present, you can use the hourly dealing ranges. Okay, then note its PD arrays, annotate it all. If you're seeing an order block, annotate that. Breaker block, annotate it. Fair value gap, all of that. So note the PD arrays in that framework and see how price respects the PD arrays at those levels. Okay, meaning if you notice a pullback, just observe how it goes or where it goes and when it bounces. Okay, I want to train your eyes to. I want you to understand when and how deep pullbacks happen and when it gives a long entry or an execution short, whatever the case is. Okay, so I want you to note all the deep pullbacks on the chart. I want to see them, and reverse engineer the pullbacks so you can understand it deeply and better. If you have any questions about that, you can ask me anytime in chat. Also, I'll go through it with you. But yeah, that's it for today. Oh, also try to understand what causes deep pullbacks as well. That's also highly important. Like I mentioned, usually what causes deep pullbacks is fake SMT divergences. If it's present, annotate that because that's highly important. I want you to see that price action over and over. But yeah, for today, that's it, guys. I'm gonna post this exercise in chat as well, so you can refer it. Actually, I'm gonna take it now. Um, but so far, if you have any questions before I wrap up, I'll take your questions. Thank you, guys. Thanks for coming by. Ivan, you want to ask something, I guess. Ivan, do you have a question? Sure. Yeah. Um, Not necessarily. So I have two rules for that actually. I'm sure you're familiar with this as well. Sometimes market doesn't just like give Judah swing or whatever. It just breaks down, right? So I have a way to anticipate that, and I have a way to expect the Judah swing as well. Basically, what I do is if I go back to that example, 1 second, let me find that. Oh, here. If I see 930 is opening close proximity to a premium array when the market is bearish, right? I would anticipate a Judah swing into that fair value gap. That's how I anticipate it. Or let's say if it's really close proximity to a liquidity pool in the opposite direction of the drawn liquidity, right? And if, especially if there is a fair value gap right above that liquidity, I would expect a Judah swing into a fair value gap, sweeping that liquidity against the direction of the drawn liquidity. You know what I'm saying? It's kind of it might be a little confusing at first, but for a general rule of thumb, what you can say is like if New York is trading into a fair value gap in the directional drawn liquidity, you usually shouldn't be expecting a big Judas range. The Judas ranges are usually bigger when it's rating a liquidity, buy side or sell side, whatever the case is. You're welcome, brother. I guess we have a couple of questions. Oh yeah, I would like you said, another reason we don't get discounts sometimes is too It's called the correlated asset has already hit discount. Some that's actually true, and also that means usually that asset, whatever we are looking at, is actually stronger than we think. That's why it's bouncing off, at a higher level. Deep pullbacks are the best avoided because it's mostly due to thick price action. Will that be correct approach, brother? Not necessarily. Deep pullbacks, it's tough. Here's the thing about deep pullbacks. Let me go on the 1 minute. There's a 1 minute example here. Okay, here. So deep pullback is happening into a discount fair value gap, right? The problem with trading this kind of pullback and going short here is that you don't know where it wants to bounce, or you don't know how much it's gonna wick, or whatever, or how fast it's gonna reverse, right? Maybe you can't even TP your position before it reverses, or maybe it could come all the way down to rejection block. You know what I'm saying? So in terms of targeting, trading pullbacks are really hard because you usually don't know where it's going to bounce. So when you put a limit order to close your position, where are you going to put? You know what I'm saying? It just doesn't make sense that much when it comes to trading that kind of price action. Does the pullback work with timing? Um, Good question. I haven't observed anything related to time when it comes to pullbacks, honestly. But what I've seen is basically it like the SMT divergences most of the time. It usually present in the market on both sides. But on the market maker model perspective, what you'll see is the actual model is happening on one side of the market, so you can disregard the fake SMT, if that makes sense. I felt a victim to that last week on Thursday. I think it was Thursday. I disregarded the buy model. I saw a bearish SMT, which caused a deep pullback, and I traded that, got wrecked. I can show you that actually. It's a great example for you guys, and for why you shouldn't be trading deep pullbacks. Let me just pull that real quick. So it was last week, Thursday, I believe. Where's the So here, this price action, what I was looking at, so there's this SMT here, okay, with ES, which sets the stage for the horizontal consolidation targets, right? That's the market maker model. So that's the first consolidation. There's one more here. You can target either or, right? So drawn liquidity 1, drawn liquidity 2. I saw this as I didn't see it at the time though, but anyways, what I did was I disregarded that. There was another bearish SMT here, okay, with ES. This was the bearish SMT. I saw the bearish SMT, divergence. I'm like, okay, I'm going short. So if I zoom in a little bit, what you'll see here is that SMT actually caused a deeper pullback. Here you can see, where is it? Hold on 1 second. Here, caused a fair value gap there. I shorted that, I think. I'm not sure where I exactly shorted, but something like that. And that's why you shouldn't be taking, that's why you shouldn't considering these structural breaks as a shift. Those are not shift. The real shift should be at the order block, which is here. As long as it keeps that level, the market is in the buy model. And it's not going to stop until it takes out the drawn liquidity. So I felt victim to this. The pullback, fake out, got stopped, paid for the price, which is why you shouldn't be trading these kind of price actions. Instead, just go with the order flow. You know what I'm saying? Like, And in this case, this is also a great example for like, let's take a look at that dealing range, for example. Never comes back down. That means market is strong and it rallies right away to the first draw on liquidity. Or here. I usually take that as a dealing range because that's the framework I want to be in if I can spot the buy model. Hourly PO3 can. Hourly PO3 does work with timing, yes. But yeah, usually SMT divergences causes these are fake SMT divergences. They cause a deep pullback. Because in this case, if you think about it, let me zoom in a little bit. If you think about it, if it's bullish, it technically should hold the fair value gap there, right? It doesn't though. That's when I consider a pullback a deep pullback. And fakes out a lot of people because along the way down, it also creates the opposite side PD arrays, bearish fair value gap, SIBI, and I was a victim to that specific fair value gap, I believe, just because I couldn't spot the SMT divergence at the lows. Yeah, here you comes. They are algorithmic deliveries. That's what I'm saying. Like you can actually, what you can do is on the way down, if you were watching this live here, you could actually anticipate that by using that wick. Like what I would do is I would probably like anchor it to the bodies, have a draw on liquidity there, maybe look at the standard deviation of this leg here to see where that comes, because it's algorithmic delivery at the end of the day. It's all measured. So I would anchor that to -2 because that's close proximity, and I would just roll it. You know what I'm saying? Like it probably goes down there and bounces right away. Jesus, come on. See where it bounced. Yeah, more or less the same level. So going further in trading all-time highs, the same logic. It's literally the same logic, just the flip side. We'll be looking for the buys. I mean, I was doing that on the 4 hourly yesterday in the weekly coverage. Here, it's the same deal basically. Like pull back here, right? Market structure shift there, and there's this dealing range from order block to swing high, never comes down to range EQ. Knowing that information, I'm implying the dealing range, anchoring the range at the range EQ at the bodies there to get a, what is it? To get an implied range EQ. That is how I got 39 level last week. So now moving further, what I do is this is the last manipulation leg, right? So I would look at the standard deviations of that level. Now we have a new dealing range there from that order block to, so this is the new dealing range now, essentially. I don't know what's going to happen though. I want to see more, upside, but we'll see. Anyways, I think I'm gonna wrap it up here, guys. If you don't have more questions, I'll probably talk to you in chat for a little bit. And I'll see you guys tomorrow in the morning at the live stream. I hope we'll get a good price action tomorrow, because I'm so done with it. So tired of looking at this chop, man. This past like few weeks, it's been rough. Not gonna lie, it's been really rough. Thanks for coming by, guys. I'll talk to you tomorrow. Take care. Have a great night.